Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder and editor of Intelligent Investor. And this morning, we are visited by Resources King Gaurav Sodhi. How you doing, Gaurav?
Hello, everyone. Hi, John.
And Canadian Graham. How's life in Canada at the moment, Graham? I know he's not
this
Canadian,
extra title.
Yeah.
No, I'm very much Australian living in Canada.
Yeah, okay. We have two subjects this morning. The first is the resources boom that we're seeing right now. Gaurav's going to give us his insights on that. We're going to talk about a few specific stocks. And then we're going to look at a portfolio of some of Australia's highest quality businesses and the performance over the past 5 years as a way into explaining why some of these businesses haven't done as well as they perhaps should. So let's kick off with resources. Gaurav, you wrote a story this week on higher commodity prices, higher gold prices, higher silver prices, higher copper prices. What on earth is going on?
Yeah, to that list you can add aluminium and lithium and zinc. There are so many, and rare earths. There are so many commodities that have just taken off. And I keep hearing and reading people proclaiming a new commodity is super cycle. And this is not new. We hear these proclamations from time to time, but this has been interesting because it's been so many people doing it so consistently now. I felt as though I needed to add my 2 cents worth.
Which is contrarian. I mean, you did say this week in the article that I've lost count of how many fund managers I've seen predict higher copper prices because of electrification or EVs. You did say that most of them couldn't tell the difference between copper and coconuts, which is very dismissive of the industry, Gaurav. So what's the thinking behind that then?
I love it when you get generalists, people who run big generalist funds or analysts who cover industrial companies suddenly realize that, oh shit, these resource companies are moving. I better, we better buy some, or we better start looking at them. That's then you start getting these quite interesting opinions. And one opinion that keeps popping up again and again is a consistent bullishness about copper. Now, I've been covering copper for about 20 years almost, John, and I've consistently heard the same tale, and it's a very enticing narrative. It's that copper mines are depleting. It is harder every year to establish a new copper mine. Grades have been declining for 30 years. 30 years ago, the average grade of copper was sort of 1.4, 1.5. It is now half of that, grams per ton, or not grams per ton, parts per million, I think it is. Well, whatever it is. And it's now half what it was 30 years ago. So you've got declining grades. You've got regulatory difficulty in opening mines. You've got depleting existing mines. And at the same time, you have this explosion in demand driven by, you name it. A couple of years ago, it was EVs. Now it's data centers, and it's going to be AI. It was the rise of China. There's always a reason why demand is going to explode. Yeah. And there's this perpetual bullishness about copper that never really gets fulfilled. And every now and again, copper will have a bit of a run, a cyclical run, and the bulls will proclaim success and life will go on. But I thought in that article, I just go through some of the actual data to show what's happened with copper over the last 10 years or so. Yeah. And in fact, despite all those narratives, all the supply issues, all the regulatory issues, and the potentially soaring demand, copper demand has actually over 10 years has only risen by less than 1.5% per annum. In fact, you can go back 20 years and it's risen 1.5% per annum, which doesn't even match population growth. So all these narratives about how copper is going to explode just isn't backed up by the data. And the reason copper
so why
has
do they all believe it then?
The story is so enticing, and as I say, there's all these generalists who really know nothing about mining and know nothing about copper, who keep keep looking at these narratives, the EVs and AI and declining grades, and it's very easy to weave a bullish tale. But the one thing I've learned about these commodity prices, these commodity markets, is that these are very adaptive systems. When one variable changes, it prompts changes in another variable. So it's very difficult to make one change and correlate that to a particular change in price. So what happens when the price of copper goes up? Or what happens when grades decline? So when grades decline, it's not just prices go up. It's that miners pour more technology and more resources into extracting more volumes. And yes, ore goes up, but volumes also go up as well.
So this is the cure for higher commodity prices, is higher commodity prices.
Yes, that's right. And that's only one part. I mean, there are so many variables that go into determining price. And I think it's very simplistic to think that you can sort of pick one driver of demand or supply and expect that to contribute to a linear change in the price. All these variables interact in a complex way. And in a market as large as copper is one of the largest commodity markets in the world. We're talking almost 30 million tons of product a year, metal a year. There's a lot of variation. There's recycling is playing an increasing part. Substitution with aluminium is playing an increasing part. There is so much variation, and I just think it's very simplistic to look at straight line narratives and draw a conclusion about the price. And that's what people are doing now. It's what they've done ever since I've covered this sector 2 decades ago.
And you would say that that's not just applies to copper, it applies to other resources too?
Yes. Well, I think copper aside, copper is everyone's favorite, which is why I've picked on it, because I keep reading everywhere, every fund manager quarterly, every live wire interview, every media article that gets written about commodities. It's we've done a lot of work and we really like copper. And I just find that, I just think it needs a counterpoint. There needs to be a level-headed counterpoint to that consistent optimism, because it's just not grounded in the facts. In the article, I spoke about why, the bulls will point to the copper price and say, well, the copper price has risen. But when you go back and look at the sources, the causes of that copper increase, there's been no real demand explosion. There's been no real supply contraction. What's happening is the US inventories of refined copper have risen 10x over the past 12 months. And what's happening is refiners in the US are stockpiling the metal in anticipation of tariffs that come later in the year. So you've had this. I would call that a bringing forward of demand rather than a change in overall demand. So I think this run we're having is very much part of the cycle and is a short-term phenomenon.
Unless tariffs go up.
Well, even if tariffs go, then you get the stockpile being withdrawn. So at some point, consumption patterns will be revealed in the price.
So what about gold and silver, which is also booming? Can you talk about that? Because we have had some success with gold. We had a mini portfolio in gold that's up nearly doubled in the past 7 months or whatever it is. Would you say there's the same thing there? It's the same kind of narrative bias that you're seeing in copper?
Well, gold is all narrative. There's no
supply demand. There can't
gold.
be anything else, right?
Yeah. Look, there are lots of ways to think about gold. The way I think about gold is as a currency. So I view it as a currency, and I think about it in the way I would US dollars or Aussie dollars, which means that no one can predict its direction. And it's folly to try and do a supply and demand kind of analysis of gold, because it's really just investment-driven demand, and it behaves like a currency, or to be treated like one. But I think silver's a little bit more complicated. There is industrial demand for gold. It is also a precious metal, so it also has monetary value. And on top of that, there are very few pure silver mines. So when most of the world's silver comes as a byproduct from other mining operations, so typically with lead or zinc or gold, you get silver byproducts. And so the miners themselves don't really control the absolute supply of silver. That's why you get these wild moves in the silver prices, because supply can't respond adequately to changes in price the way it can with copper or iron ore.
Yeah.
So you get these wild swings in price, which is very normal. But there is information in these price movements, just as there is information in changes in the currency. And I think what's happening across the commodities sector, and it's particularly clear in these precious metals, is that there's this building distrust of the American dollar, and I would say American assets more widely. There's no question that the primacy of the American currency is now in open question.
Yeah.
The BHP now sells between 20-25% of its iron ore priced in yuan, which is unheard of. There are global oil sales now being done in foreign currencies. Again, first time in modern history that's happened. So these are big moves that are happening. And I think it's easy to dismiss concerns about the American currency as specific to this administration or short-term or unimportant. But my view is that we're seeing a change in the financial epoch. Like the era is changing. And it does, I think, I mean, I made the case earlier last year that, yes, we were late to gold, but it better late than never. And our sort of gold mini portfolios have done extremely well. And I think it makes sense to hold hard assets and gold in your portfolios. And I think the rest of the world is coming to that conclusion. So the rise in commodity prices is not being driven by demand-led factors the way it was in the last cycle when China was growing. It's being led by monetary factors. And it's really a result of US dollar suspicion and specifically US dollar decline.
Do you buy this de-dollarization argument, Graham?
Well, it seems like that there must be something driving all of them together. So that seems like a good catch-all reason that it would kind of influence all of them at once. Part of me wonders whether there's a simple, another kind of explanation that lurks into it, where as the kind of geopolitical instability creeps up, countries and corporations just get a little bit more greedy because they aren't sure where they're going to get their next, batch of gold or copper or whatever. And so there's a bit more hoarding going on. I'm not sure if you're seeing that in the numbers, Gaurav, but it kind of makes me think that as risks go up, generally people tend to hoard more and they tend to try and grab what they can while they can. So do you think that's playing into it?
You're not wrong. There is certainly more stockpiling happening, and it's not just in precious metals. Like the stockpile of copper, there's now stockpiles of rare earths being established, and these are government-held stockpiles. And that's because the trading system, a couple of years ago, I'd say we had pretty open trade between countries, and China sold a lot of refined metals to the US and the West. And though the trust in that trading system is now breaking down, so countries are hoarding metals in far larger quantities than they used to. That over time, that should be a one-off thing where inventory levels kind of jump in unison and kind of stay high. That really shouldn't affect long-term prices, I would have thought. But certainly while that transition to higher inventory levels continues, you should see prices. That's one possible explanation. It's possible, Graham, that this is just a kind of a one-off move we're seeing as these changes get fed into logistics systems and supply chains, and then everything goes back to normal. That's possible as well.
Is that your bet?
I think there's more going on there. I really think just listening to European companies, you only have to listen to, like, it was fascinating listening to these Davos speeches and reading about. Why
would you put yourself through that, man? I mean, I think Carney was,
there was him, but there was so many others. I mean, when if you think we're living through a potential change in the financial epoch, a potential change in era, I think you would have to take that serious. That has huge impacts. No one thought when the gold standard ended in the 70s, when the US woke up one morning and renounced to the world, we're actually now not going to link our currency to gold. I don't think people realized how important that day was. And it was only in the following decades where we realized what a monumental shift that was. And now we would call that an epoch change.
Yeah.
And we may well be upon another one now.
Yeah, I think that's quite true. I was just doing my pecuniary interest this morning, and there's some amazing stats about how 2019 China's exports, the US share of China's exports was about somewhere between 17 and 20%. Estimates vary. It's now half that. So in 6 years, they've just not reduced their exports, but reduced their share of exports by just exporting to ASEAN nations, South America, Africa, and places like that. Also Europe in favour of the US. So the tariffs just aren't having anywhere near as much impact. They're having far more impact in the US than they are in China. It's just another aspect of, I wouldn't call this deglobalization. It's a kind of a rerouting around the US.
Rerouting, yes.
Yeah,
yes.
and I think you can look at the monetary side of this, which is the argument that you're making, that you can see it in the trade figures as China sort of reroutes it around the US and other nations too. And you can see it in the monetary aspects with what you're talking about there, Gaurav. But what are the implications for investors here? Do we all pile on the gold train, or what should they do if you accept your argument?
I don't know what the answer is here. This is more, I think,
Graham.
Don't think, just buy.
Don't think, just buy. That's always good advice, Graham. You're onto it there. I think we just need to be aware. I mean, ordinarily, if we saw metals prices moving and an absence of demand supporting those moves, it'd be easy just to sell BHP and the gold stocks that we own and some of the other mining businesses that we own. That would be the obvious choice. I just think it's not that easy at the moment. Decisions, it's hard. If you're invested in commodities, it is difficult because you've got financial reasons. You've got commodity prices moving because of financial considerations, not necessarily industrial demand-driven considerations, and that's legitimate. I mean, that's not necessarily a wrong thing. That will be reversed. But it does make things hard. Look, all I'm saying is act slowly at the moment. This is not the time to be piling into anything or to exit swiftly. I think this is really a period where you want to be cautious. And by cautious, I mean pick your assets carefully. Definitely stick to quality at this point of the cycle, and watch position sizes as well. Ordinarily, I put quite large chunks of my portfolio into specific positions. That's not happening at the moment. I'm far more cautious about position sizes.
Graham, anything to add to that?
I better sell my silver CFDs.
After you've sold all the silver cutlery, that silver spoon that I found in your mouth, Graham, you better sell that first.
I'm changing the plumbing in the house at the moment. I might sell my copper.
Sell the copper? Yeah.
Sell the copper, yeah. Okay, we're going to take a short break, and when we're back, we will be talking about some of Australia's highest quality businesses that really have surprised in a very disappointing way.
Think investing's out of reach? Think again. With InvestSmart's Fund Later, you can own a $10,000 ETF portfolio with just $4,000 up front. Fund Later covers the rest, lending you $6,000, which you repay over 20 monthly installments, including a facility fee. There's no interest, no margin calls, and no waiting. Whether you're new to investing or a parent looking to give your kids a brighter future, it's a smart way to fast-track your investment journey. Choose from 4 expertly managed portfolios and get $10,000 working for you from day one. Learn more at fundlater.com.au. Terms and conditions apply.
And we're back. So I did a little exercise before this podcast. And
no wonder you're sounding so huffed and puffed.
I know.
It's very unlike you.
Plumber as well. I'm running around for the plumber as well this morning. It'd be nice to have a toilet back instead of making these sort of bi-daily visits to Bunnings. Now, we have got 7 stocks in this portfolio. ARB, Xero, Cochlear, CSL, WiseTech, REA Group, and Reece. Now, I think you guys might argue about whether they're the best quality businesses in Australia, but I think we'd all agree they are some of the highest quality businesses in Australia. Mm-hmm. If you look at their 5-year performance, ARB, four-wheel drive accessories manufacturer, down 34%. Xero, accounting company, online cloud accounting company, down 26%. Cochlear up 28%. CSL down 36%. WiseTech, despite its travails, up 74%. REA up 22%. And Reese down 12%. When you average that return out, that portfolio would have delivered an 18% return over 5 years, so barely beating inflation. Wow. The ASX 200, on the other hand, has risen 30% over the last 5 years, so underperformed by a factor of half. How is it that these high-quality businesses can have such a poor kind of track record, performance record over the last 5 years? And what does it tell us about opportunity and where prices are now? Graham, why don't you kick off with that?
Well, it's interesting. The first thing that struck me was that if they're up 18% and then like if you average that over the 5 years and then you throw in, I assume most of them would have paid a decent dividend, and that must have been a 6-7% return still, which is below the kind of historical average, but that's still beating GDP. So maybe that's a sign that the quality businesses are still able to tick along and beat the economy as a whole. But it is below what the market has historically done. So I guess there's a flip side to it. But yeah, I'm not sure. In terms of why quality is underperforming, I think there might be something to do with it just being, over the last 5 years, there's been so much inflation that's been well above the kind of 2% that most central banks target in Australia, overseas, everywhere, that kind of just the general income that people have got is probably fallen by 20% or so in terms of their real spending power over those 5 years since the pandemic. So maybe it's just that a lot of the items that those companies are selling are somewhat discretionary, not Cochlear, but the other ones. And with a rising cost of living and people have less to spend, maybe that just does pull down these higher quality businesses, that it's nothing really that the businesses are doing wrong. It's just that everyone's got a little less to spend on them.
Gaurav, what's your take?
I think it says something about the starting valuations that you're buying these from. I've long been looked at, and before I begin my rant, let me just say that I fully understand that there are different ways to invest, and I am a big fan of that. I think we should invest in a way that is consistent with our psychology and our own behaviors. So you need to find a method of investment that works for you. And for me, I've never been interested in collecting building a collection of the highest quality but expensive businesses. I think Howard Marks has it right when he says investing is about two things. You have to do something different and you have to be right. Over the last 10 years, I'd say the consensus trade has been to just buy quality. When there's been a dip in price, everyone's just bought it up. We've been on record many times, John. I'm sure you remember particularly Nick and I ranting in Monday meetings about how expensive these quality stocks are. Lord knows we don't need another rant from Nathan about CBA, but these quality businesses have been really, really expensive. I would say for almost a decade, and this is the inevitable result of buying at elevated valuations, is that your expected return goes down. I will say that buying quality means that it can prevent disasters. You noticed although those returns are low, they're not disastrous. Yeah, you haven't torched value, and that's what quality does. It's a defensive measure. But if you want to generate returns, I think that whole thing about doing something different is very important. You have to buy at a sensible price. And I think we've forgotten, well, not us, but investors generally have forgotten the price, the importance of price when it comes to future performance. This is a reminder of that.
Yeah, price does matter.
Some of these valuations were crazy. I mean, we were looking at Supply Network. We were looking at Xero, Technology One. Technology One, I just could not believe the price people were paying for that. It was really silly. Pro Medicus has been the only stock where I think internally and certainly myself, we've sort of said, okay, this deserves a silly price because it is such an exceptional business. But everything else, I couldn't understand what was going on. Like, I just thought the world was mad. And we said that many times. We wrote about it in pretty strong terms. And as I said, I think this is the inevitable result of excessive starting valuations.
I think there's another thing in that list as well. When you look at Xero, which is down 26%, and Reese, which is down 12% over 5 years. I mean, maybe I'm drawing too long a bow here, but of the three companies that really have underperformed, two of them have undertaken very large acquisitions.
Oh, that's interesting. Yeah. That's a good point.
CSL, I think, has got its own internal problems and structural headwinds and so on, but the other two...
Also acquisition
driven as well, right?
Yeah.
So
that's interesting.
And this is often how big high-quality companies do go bad. They make expensive acquisitions and just talk the growth aspect and the synergies, and it doesn't happen. It's often how it goes wrong. But yeah, I take your point. There is a price that people need to pay. So are any of these stocks on that list looking interesting now, Graham? Are there things there that jump out at you and go, you know what, this might be a good time to look at Xero again, or look at CSL? I mean, and that's on the buy list right now. Any more on there that you would like?
Well, CSL's pretty close to being upgraded again. We've got a buy price at 150. I mean, CSL is a high quality company. I don't think many people would debate that, but I think you're right that if you overpay at the beginning, then you've just got to accept lower returns. And 5 years ago, people were paying a lot more for CSL than they are now. Not in absolute share price, but in terms of the underlying earnings of the company, because over that time it's continued to grow and it hasn't been a disaster at the company level. But if you overpay for that, then it's a big problem. Yeah,
that's interesting, isn't it? Just to highlight that point, Graham, I think that's really interesting that if you looked at the actual financial numbers of these businesses, maybe there are a few exceptions, with Reese being a prominent one, but the others have actually performed very well. If you are the owner of that business, right, the actual financial metrics have been great. It's just the starting valuations were high.
I always find that an irony with these high quality businesses is that the people that end up paying too much at the start, they're usually right about the company, that they're paying this huge premium because they've judged that its earnings are going to grow for the next decade and it's going to outcompete everyone and all of that. And they can be right, but still make a poor investment of it if they pay too much for it.
Yes.
Yeah, it's funny how it plays out.
The other thing we haven't spoken about, but that is certainly topical, is this this, what are they calling it? Software-geddon? What's the term for it, John? Do you know what that's being called? SaaS-geddon, thank you. I think that's wonderful, by the way. I love that.
I think I just invented that. I haven't read that.
Did you? I've heard people talk about some sort of geddon, and I don't know if it's net-geddon, SaaS-geddon, software-geddon. Yeah. Anyway, these software stocks are getting just torched all over the world. I think Australia has probably been spared compared to some of what's happening in the US, but they have been torched. And there's a big debate going on at the moment about how AI will disrupt software stocks. And you can see that debate kind of playing out in multiples, which have just contracted spectacularly in the entire software sector. So there's that as well, Jonathan. I would say more recently, that's been a feature of all software businesses.
Yeah. I mean, again, this goes back to the kind of issues that you were raising in the first topic, Gaurav, is there's a kind of narrative that takes over. We're all subject to narrative bias, and there's a kind of herding effect. Like, everybody thinks AI is going to be huge and it's going to kill all these enterprise software businesses. I would question that. I'm not so convinced by that argument. I think it's quite hard to, for the banks to go out and replicate in a few months with a team of a couple of hundred people their entire systems and all the integrations they've got. And if you've got AI doing it, something goes wrong, like, is AI going to fix that? Like, if you don't have a kind of team of people who know where the errors are coming from, those errors become much harder to fix. And to give you an idea of where AI is at, in this segment, we've been talking about 7 companies, and I just did an AI query in Gemini and ChatGPT saying, give me the price of those 7 stocks 5 years ago, give me the price today, and create a table calculating the share price difference. Couldn't do it. Both failed.
Oh, wow. Okay.
That's where we're at. So maybe this is possible, but I don't think that the SaaS sector is going to get wiped out. I've got a vested interest in hoping that doesn't happen. But I'm a bit more skeptical of that argument. But that might provide some opportunities for us down the track, I think, in these SaaS businesses. We're probably already seeing it with some of the stocks on the buy list right now.
I'd like to get Graham's view on this as well, but I'm a bit more reticent on this, actually. I think it's quite possible. I'm much more cautious about SaaS, and I do worry about AI disruption. I think what I'm concerned about, John, is not so much that enterprises set up, what are they called, vibe coders? I don't. That's not really my concern. No. But it dramatically lowers the cost of new entry, and I think you can have all these startups who use large language models or AI from the very beginning. And they will just be so much cheaper, so much more flexible than legacy enterprise systems. And more competition always drives down prices, always drives down profits. And that's my concern. So at the very least, these companies, which were trading on really rich multiples, those multiples deserve to be compressed. So I'm less convinced that there's an obvious wholesale opportunity, but I certainly think there are pockets. There are specific businesses that are better protected than others, and I think that's kind of where I'm interested in. But I'm probably a bit more concerned than you. Graham, where do you land? Somewhere in the middle, or whose side are you going to take here?
I don't know. I was just trying to think through if I had to pick a side, but
pick a side.
I actually think it'll be John this time. Where until more recently, I've been more concerned with AI's effects and all of that and how it can be very disruptive. But I also just have in the back of my mind stuff that I see in healthcare and the medical field specifically, where you can have a new drug that gets released, which is a total game changer, and it can still take a decade to actually get out there into the hands of patients, because there's so much momentum behind the healthcare system, all of the training, all of the reimbursement rates. Just there's so much stuff in the economy that ends up creating this massive machine that just can't move quickly. It's like a
machine that can't move quickly.
Something. Yeah, exactly. And so I think even if you buy the argument that AI could be totally disruptive, it could still take a long time to actually really change things dramatically. And the other thing is that I think that, kind of like drawing it back to your copper argument earlier, that humans are very responsive, and that if we start seeing changes and as they start coming through, that we adapt to things, companies adapt to things, and it may not be as disruptive as it seems, particularly if it's that slow kind of pushing against the momentum of the economy that I mentioned before. So I don't know. I used to be, if you'd asked me 2 years ago, I was a lot more nervous, but now I might be falling more towards interesting technology, probably going to make a lot of changes. You do have to pick your industries and companies of which are going to avoid that disruption, but I just don't see it happening as quickly as I think some CEOs seem to predict it in that space, that is.
That's so interesting. I've had the opposite trajectory. I was completely unconvinced even a year ago, but watching the rapid progress of these AI systems is terrifying. And all you need to do is spend 15 minutes with anyone who knows something about software engineering, which I do not, which is why I spend time with people who do. And it's really scary what they tell you. People I spoke to are convinced that coding is over, that these systems can write themselves. Like there is so much. We are so early on in this very large revolution. Like I'm very nervous about it for software businesses.
One of the arguments against that is that imagine, I don't know, everybody can make a car. Around the time of the Model T Ford. Just because everybody can make a car doesn't mean that everybody can sell a car and do it cheaply and do it well. And a lot of these businesses, it's not their core business. Like if you're a bank or you're a big corporate, a multinational, and you want to recode all of your systems, now that's not your core business. Why wouldn't you just carry on paying the people who are doing what they're doing and improving those products through AI, like Car Group is doing, for example? You could say Car Group could be demolished by AI, but it's also can deliver far better services with AI, and they've already got all of the customers. So you might have a couple of kids who, go on.
Two rejoinders that. First of all, I think the classifieds are a different species. I'm not at all convinced that classifieds are in trouble. I think the enterprise software in particular is in trouble. And that's what I'm concerned about. But the other thing is, it reminds me a little bit, John, about of telcos who own their own network. But what's happened once networks are digitized is that it's become very easy then to resell parts of the network. And what that's led to is specialist firms like a Maysim who where their core competency is in billing and selling, and they don't do any of the actual network build. And those companies, they're not big. They don't become number ones or twos, but they put an effective price cap on what these network operators can charge, and their returns on capital have never been the same since those competitors have come into the space. And I think it's the same sort of thing. I mean, what AI enables software enterprise companies to do is to set up as specialist selling and administration providers without any of the expensive coding engineering. That can all be almost outsourced to AI.
Right, so it becomes like resellers on the NBN.
Exactly. They become like resellers on an NBN. Yep. And it caps your prices. It makes churn easier. Like, it just hurts your returns. It doesn't kill your business. It just hurts your returns.
So software becomes a commodity.
Yes. I think that's the concern.
All right. We're going to leave the conversation there because, speaking of number ones and twos, I need
the toilet.
And I'm hoping that the toilet will be installed by then so I can actually perform that task. So there's no chance of this podcast going on any longer. I want to thank you both for your time, and we will be back again in 2 weeks.